Let me ask you something. When was the last time you actually walked through the unique strategies available just for Canadian business owners? Not the same cookie cutter advice you'd hear at other places. I'm talking about strategies that protect your business, reduce your taxes, and turn your company into a long-term wealth engine. The truth of the matter is this: too many small business owners in Canada spend decades building something valuable, but they don't build wealth alongside it. They're overpaying in taxes, underutilizing their corporations, and missing out on financial planning opportunities that could save them tens of thousands of dollars every year. In this video, I'm going to share a few practical, high-impact strategies every Canadian small business owner should know, from how to structure your cash flow and protect your family to how to build wealth inside and outside of your corporation. If you're a business owner in Alberta or anywhere across Canada, this is for you. Hi, if you're new here, my name is Stefano Francesca, and I'm a certified financial planner professional at Next Step Wealth with IPC Securities Corporation. For over 30 years, I've helped Canadian families and business owners build long-term wealth, not just through investments, but also through smart risk management and tax-efficient planning that fits real life. And when it comes to small business owners, the right financial plan is everything, because your financial future just doesn't depend on your business. It depends on how you integrate both business and personal financial matters. If you find this video helpful, be sure to like, comment, and subscribe. And if you're ready to get personal advice, the link to book a call with me is below. All right, let's get into it. Part 1, stop taking every dollar as a paycheck. No, seriously. If you're running a successful business, it's tempting to think, I'm earning more, so I'll just pay myself more. But that mindset, while logical and beneficial for a lifestyle, could be quietly costing you tens of thousands in unnecessary taxes. Let's break it down. In Alberta, your personal income tax rate climbs quickly. Once your total taxable income goes over $181,000, you're already in a 42% tax bracket. At $253,000, you're essentially into the highest rate at 47%, and then max at 48% over $360,000. Compare that to your corporate rate on active business income. Thanks to the small business deduction, it's only 11% on the first $500,000. So when you pay yourself a salary that you don't need and it eats into your small business limit, you're giving away dollars in tax differential that could have stayed in your corporation, taxed at a fraction of the rate. It's this tax differential that really makes a difference in long-term wealth accumulation. By leaving dollars within the corporation, you've deferred personal taxes, given your company more capital to work with, your corporate profit is taxed at a lower rate, leaving even more money, and you've opened up the future planning options like a holding company and corporate investing. With our system of tax integration, it's not necessarily about avoiding tax, it's about timing them. Pay yourself what you need now, defer the rest until it's strategic. Here's what smart business owners do. They take a reasonable salary for their lifestyle and to fund RSP and TFSA accounts. They use dividends sparingly if they need more cash flow, and leave excess cash in the corporation where it can be reinvested or used to fund future planning strategies. The more you understand how to structure your compensation, the more control you have over your taxes, your savings, and your future retirement. Part 2, build wealth inside your corporation, not just outside it. We all know the importance of investing, but where you invest from can make a massive difference. If your corporation is generating surplus cash beyond what you need for operations and personal expenses, that capital doesn't need to sit idle, and it doesn't need to be paid out. You can invest it inside the corporation and start building long-term wealth. Why this matters? Lower corporate tax rates versus personal rates. That means you can invest with dollars that haven't been taxed at those highest personal rates, giving you more capital to work with up front. Now, yes, passive investment income inside a corporation is taxed differently, often around 50%. And if your corporate investments generate over $50,000 in passive income per year, it can begin to claw back your small business rate on active income. But with the right planning, you can navigate this. By using efficient investment vehicles and working with a qualified advisor, you can preserve the small business deduction, grow your capital inside a corporation, and maintain personal tax deferral, all while keeping control. Real-world examples of corporate investing can include corporate class funds. These are designed to minimize taxable distributions, helping you reduce tax drag inside the corporation and maintain long-term compounding. An investment holding company. A holdco can isolate investments from business risk and create flexibility in estate planning or income splitting strategies, as well as purify an operating company to preserve your capital gains exemption. Permanent life insurance. One of the most tax-efficient tools available when structured properly, offering tax-exempt growth, potential tax-preferred income, and the ability to pass assets tax-free to your estate. An individual pension plan, or IPP. An IPP is usually best suited for business owners or incorporated professionals age 40 plus who have been collecting a good salary for a while. Contributions are deductible to the corporation, and the corporation can make higher contributions to the IPP than you could have made into an RSP, thus creating a larger nest egg. If all of your wealth building is happening outside of your corporation, you're probably missing one of the biggest tax planning opportunities available to you. This strategy isn't for everyone, however. If you plan to take all your profits out personally, or if you're investing in the wrong types of assets, the benefits disappear quickly. But if you're building a long-term plan and coordinating closely with your tax advisor, investing inside a corporate structure can give you more capital to grow, more tax deferral, and more flexibility for the future. It's not just about investing more, it's about investing smarter and structuring your plan so every dollar works harder for you. Part 3, plan your retirement like you'll never sell. Let's be honest, many small business owners assume their company will one day fund their retirement. The plan usually sounds like this: I'll sell the business for a few mil and that will be my retirement plan. But here's the problem. Most businesses don't sell the way their owners expect. They take longer to sell, the offers are lower than expected, and in some cases they don't sell at all. In fact, in Canada, only a small fraction of small businesses actually sell successfully when the owner is ready to exit. So what do? Plan your retirement as if you never sell. That means asking, if your business shut down tomorrow, would you still have enough to retire comfortably? Have you built up personal assets outside of your company in TFSAs, RSPs, non-registered accounts? Have you created passive income streams that aren't tied to your business? By planning your retirement independently of your business, you give yourself flexibility. If the sale goes well, fantastic. That becomes a bonus to your retirement plan. If not, you're still covered because you didn't tie your entire future to one outcome. How I help clients in this situation. For my business owner clients, I like to create a base retirement plan, something that shows what retirement could look like even without the sale of the business. From there, we layer in what if scenarios. What happens if they sell for $500K? What if they sell for 1.5 mil? What if it takes longer than planned? What if they receive a structured payout over time rather than a lump sum? This way, they're not hoping for a good outcome. They're planning for many outcomes, and that gives real peace of mind no matter what happens. Part 4, protect your business with the right insurance and understand why it matters. One area that's often overlooked by small business owners, especially in the early years, is insurance. And I get it, insurance isn't flashy. It's not a revenue driver. It's one of those I'll get to it later items on the to-do list. But here's the hard truth. Not having the right insurance coverage can put everything you've built, your business, your personal assets, your family's future at serious risk. When building a house, you begin with the foundation. Insurance sets your strong foundation so you can build everything else around it. There are 2 key types of insurance that every small business owner should be thinking about. Firstly, business insurance. This includes coverage for things like general liability, in case someone gets injured at your workplace or due to your product or service. Professional liability, if you're sued for an error or omission. Property and equipment coverage, especially important if you own tools, equipment, and inventory. And as well, cyber liability, if you collect client data or use cloud-based systems. In Alberta, many small businesses operate in industries where even one mishap, a faulty installation, a data breach, or an accidental injury could lead to thousands in legal and repair costs. Without proper coverage, you could end up paying those costs out of pocket and potentially jeopardize your business's survival. Secondly, personal insurance that's structured for business owners. This is where we can add real value. Many business owners don't have employer-provided benefits or pension coverage, which means the responsibility to protect your income and your family falls squarely on you. At minimum, you should be reviewing the following: your disability insurance coverage to protect your income if you can't work due to illness or injury, critical illness insurance for a tax-free lump sum payment upon diagnosis of a major illness, and life insurance to protect your family, to fund a buy-sell arrangement, or to secure key man coverage for your business. But more importantly, the structure of your policy matters. For example, you might own a life insurance policy through your corporation to pay premiums with corporate after-tax dollars taxed at a lower rate. You might use a corporately owned policy to fund your estate or even enable a tax-efficient shareholder buyout as part of a buy-sell arrangement. You could use tax-exempt policies within a holdco to grow assets tax-sheltered with the added benefit of potentially using the policy to remove dollars tax-free out of the corporation. Policies can also be used as an equalization tool in a family-run business scenario. By paying the proceeds to an estate via capital dividend, corporately owned life insurance can fund tax liabilities and equalize the value among estate beneficiaries for those both working in and not working in the business. These aren't set it and forget it policies. There are many complexities in both the policies as well as tax provisions associated to them. They should be reviewed regularly to ensure they still meet your goals and that they're structured in the most appropriate way. Part 5, build a collaborative team. Many small business owners lean on one trusted advisor for everything, and more often than not, that person is their accountant. And with good reason. Accountants are the first line of defense for most business owners. They help with filing taxes, staying compliant, and avoiding unnecessary red flags with CRA. They know the numbers inside and out, and they're absolutely essential. But here's the thing, business success today, especially for owners thinking about retirement, succession, or estate planning, requires more than traditional forte in historical reporting. That's where collaboration becomes powerful. To truly maximize the value of your business and your personal wealth, you need an advisory team that looks at the bigger picture. A tax accountant to help keep things compliant and efficient, a corporate lawyer to protect your structure and mitigate risk, and a certified financial planner who can bring it all together with an eye to the future. Case in point, a client of mine, a successful contractor here in Alberta, had a great relationship with his accountant but didn't have a broad advisory team. When we stepped in as the financial planning partner, we added complementary value. We identified unused corporate structuring opportunities and brought a lawyer on board to help restructure, coordinated personal and corporate investments using tax saving structures to reduce both corporate and personal taxes. We put an insurance-backed shareholder agreement in place, and we built a retirement program that tied his business exit strategy to his long-term goal. The result? A stronger long-term plan. When each professional plays to their strengths and works together, there's a real synergy created. Just a smarter, more strategic path forward. So if you're a business owner, ask yourself, do I have the right team in place? Are they talking to each other? Am I looking backwards and looking forward? Being a small business owner in Canada comes with a unique set of financial opportunities and risks, from cash flow and tax planning to retirement prep and risk protection. The decisions you make today will shape your long-term wealth and the legacy you leave behind. You don't need to figure it out all on your own, and you shouldn't have to. If you're a business owner ready to get organized and build a financial plan that works as hard as you do, click the link in the description to book a consultation with me. Let's take the next step together.